Welcome to a special edition of Market Pulse from Equifax, where we break down what's shaping the mortgage industry today and what happens next.
Welcome to a live edition of the Equifax Market Pulse podcast, recorded at MBA Annual 25 in Las Vegas. I'm Jennifer Henry. I'm the Managing Director and Chief Strategy Officer for Government Credit, Capital Markets, and Housing Strategy at Equifax. I'm joined today by Andrew Davidson, President of Andrew Davidson Company, one of the nation's foremost experts on mortgage analytics, credit risks, and capital markets, and also the founder of Financial Lifecycle Education Companies. It's great to have you here, Andy.
Oh, Jen, it's great to be here with you today.
All right, Andy, to set the stage for our listeners, could you please start by explaining in simple terms what a credit score is and what it aims to measure?
Oh, sure. Anyway, thanks for mentioning our not-for-profit financial lifecycle education. What we've done is combine finance and mathematics for educating high school students about financial topics. And one of the areas we've been working on recently is credit scores. And incidentally, just Friday, I was at a math conference basically talking about a new lesson that we're creating about how credit scores work. And what I've learned from that side, as well as the Andrew Davidson Company mortgage side, is that many people don't really understand what a credit score is. It's just a number to them. And what we've been trying to do is delve into what exactly is a credit score, for our mortgage clients as well as for these students. And the way I like to think about it is a credit score is something that's generated using the data in a data file, and notably only the data that's in the data file. And then the credit modeling companies, VantageScore and FICO, have done historical analysis of how people with similar credit files have performed in the past, whether or not they've become delinquent on one or more of their accounts.
Interesting.
And then what happens is they take that experience and they apply that model to the data that's in the credit file now for each individual. And so once you understand that the credit score is really a model applied to a credit file, you can start to understand a little bit better the strengths and weaknesses of that credit score.
That's really interesting. Can you elaborate a little bit more on that? So, how do credit scores differ based upon those different groups of people?
Yeah, so, a lot of people think you have one credit score, and the credit score is everything to know about you. But, we now have two different companies creating credit scores as well. We have three different bureaus with data. So the credit score could differ either based on the data by those credit bureaus or by which scoring company that you've used. And an analogy I like to use is imagine you're at a company or two different companies that were going to evaluate people based on athletic ability.
That's interesting.
And one of them said, we're going to look primarily at weight. We'll look at some other things, but weight is the thing we concentrate on. And another one says height is really the thing that we determine athletic ability. And let's say the sport that they chose to use their scores on or develop their scores from was throwing a javelin. Okay. Maybe not something everyone does every day. But so they develop a score. One has more of a weight aspect to it. The other one has more of a height aspect to it. And they both do a really good job of forecasting how far people can throw a javelin. But you can imagine that the score that is based on weight might have a tall person and a short person in the same category, right, getting the same javelin distance. And then the one based on height could have a lighter person and a heavier person still in that same height category. And, they are going to have these different aspects to them. So they both do a good job of forecasting javelin throwing. But let's say we're going to use it for football or basketball. It could be that one of those scores is going to do a lot better than the other. Right. Because a score isn't just how well you throw the javelin, it's also which bucket you were put in. Right. Were you put in a bucket with other people your same height, or were you put in a bucket with other people your same weight? And I think that's what people really haven't understood about credit scores, is that it's all about how the people are grouped together and how they've come up with a score for that group, not just for you individually.
That's interesting. So how do you think that is going to impact the industry now that the FHFA has announced that they're going to move forward with the acceptance of this additional credit score, having Vantage now be part of the process?
Yeah, so I think there's sort of two big issues. One is that people just haven't really started to focus on this because the process of adding VantageScore has been a lot of start and stop, and there's been other confusion brought into that. And it's a big effort, and so people just haven't spent the time to put in that effort for something that's not certain yet. But I think even more fundamentally, everyone has just viewed credit score as just a credit score. And it's as though there was only one, and as though it was always correct, and that was the credit score for that person. And I think this is really going to have people start to focus more intensely on what a credit score means, why you could have different credit scores from different scoring companies, or why the scores different from scores calculated on the data from each of the bureau. And this fundamental idea that it's data and a model, original data and a model based on that, and then that model applied to current data is something people don't really think about that carefully. And this is really going to force people to rethink what a credit score is and how they use it. And I think it's going to be a long process.
Yeah, well, that was going to be my next question is, okay, so it's announced that effective immediately, the GSEs are going to be able to accept these new, well, at least Vantage for, in addition to the FICO 5. So what is the industry readiness? Like, what do you said you think it's going to take a long time. Like, what do you think readiness is, and what do you think that the industry needs to be able to get ready to adopt these scores?
Yeah, I think it's important to think about, like, what do you think of as the industry? And our focus is really primarily on the investor community and how they incorporate the data that they receive from Fannie or Freddie or from another originator through a trustee and through a complicated process into their investment decision. So on the front end, it's mostly an operational question as to whether or not a loan will get accepted by the GSE and how to transmit that data. For the ultimate investor, they also have to make decisions about the risk associated with that data. And people, I say, have just become very comfortable with the idea they just had one credit score. So there's just so many processes that have to happen. First, the data has to get to the people who are making these decisions. And that means it's got to flow through many different processes. Second, they need to have models that they can use on that. And even as a model provider, we don't know yet what kind of models they will need. And it often takes, months to years for people to adopt a new model. And then even beyond that, people have a certain intuition from something they've worked with for years and years. And developing a new intuition, a level of comfort with something new also takes time. So while it may be mostly like an administrative aspect on the origination side, on the investor side, it's really a complex process of information flow, modeling, and comfort. And I think all of those just take a lot of time.
And do you have any perspective on like what type of information that you think that the investor community is lacking at this time?
Yeah, I think, so one is they haven't really seen the scores live, right? So there was a data set provided on VantageScore over a certain time period, which I think was very valuable, but that's not the same as it flowing through your actual decision process. The second thing is, as I sort of mentioned earlier, I don't think people have really focused on what a credit score is and why you could have a VantageScore and a classic FICO score that differ by 50 points.
Right.
And 50 points is a lot. It could be double the amount of credit risk. It could be a 5 or 10% change in prepayment speeds. So understanding that it doesn't mean one is right and one is wrong. It's just that there was a different grouping of people may affect them. This is further compounded by lender choice. So investors are always fearful that the person selling to them knows more than they do and is going to take advantage of them in what they call adverse selection.
Right.
And when you have adverse selection, you're going to either say, I'm not going to participate in that market, or I'm going to treat things like they're the worst possible that I could imagine. And it's going to take a while for people to understand how this lender choice is working and how much worse is the performance than if you were given all of one score, all of the other, or ideally both, both scores. And these are just things that are unknown. And investors, they take risk, but they don't like the unknown, right? Investors like to know which risks they're taking, and unknown risk is not one of their favorite things.
Yep. So is there anything that you think that we could be doing as industry leaders to bring those groups together to start sharing information?
Yeah, I think we really need to open up the black box of what a credit score is. And it's not like anyone has been keeping it a secret, but it hasn't really been the focus of education.
Yeah, because people haven't really needed to know. There's one score. You don't really need to know anything about it. It just,
right, you didn't need to know. And it didn't really matter what that score was because you knew how it worked, right? Like even for consumers, people don't really describe what a credit score is, a ranking of log odds ratios, right? Instead, they just say, above this is excellent, this range is good, this range is poor, but investors need to think about numerically.
Right.
And then they also need to have intuition. And, I think we need to just start really educating people. Like one of the questions I ask people is, credit scores are some sort of measure of risk, maybe a ranking. How much change in credit score does it take for the risk to double?
Yep.
And I would say almost no one has ever answered that question correctly when I've asked them. The answer, because people know, is around 40 points, right? And so if you're looking at credit scores that might differ by 20 to 40 points, that could be 50% or double the amount of risk if you don't recalibrate.
That's pretty impactful.
Yes.
So I just shift gears a little bit. So we know that the credit scores are based upon the underlying data that's being contributed.
Yes.
So that's the credit data from Equifax, Experian, and TransUnion. There's been a lot of pressure in the market to potentially move from a tri-merge to a bi-merge or a single file credit report. And you've had the forethought over the past couple of years to kind of start looking at that data and to really understand what the potential impacts could potentially be or could be if we were to move to one of those models. And I just wanted to get your insights on what the impacts could be to the investors, consumers, lenders, and all of the folks in the process.
Yeah, just as we were talking about the difference between, two different models, the weight model and the height model. The other piece that we talked about in the definition of a credit score is that it's based on the data in the credit file. And originally the credit scoring companies, I understand, we sort of had a regional focus, each of them. And so it was important to combine them together in order to get sort of a fuller picture. So the regional differences are largely gone now, but each of the companies has focused on different types of additional data. So we still face the fact that if you pick data from firm A, B, or C, the data in the file that you're using to calculate the credit score is going to be different.
Right.
And so once again, you can get different credit scores based on which bureau you're in. And, obviously what we want is to bucket people or put them in the group that's most representative of their risk. We don't want a credit score that's too high because you may end up lending to someone who can't afford that loan. And you don't want a credit score that's too low because it may cost the person more than it would cost otherwise. And so bringing in a variety of data sources is actually very useful for that. Now, there may be some situations where we don't need that much data, that the person has a large, thick file at all three bureaus, and you're just not going to see that much difference. But as you start to get to borrowers thinner files or new people you're trying to bring in, or people have had a credit problem in the past, the fuller picture may be more valuable there. And obviously there's costs associated with that, and at some point the market's going to have to figure out what trade-off it wants between sort of more information and lower cost, right? If you're going to have more information, it's going to cost you more. But once again, I think people haven't really focused on what the difference is between the credit bureaus and how they've operated over time.
Yeah.
Now, obviously, there's people at banks who are doing credit card lending who know all of this stuff, intensely well, build their own models. But most of the investor base, certainly in the securitized market, just isn't that focused on all these details.
So on that note, the difference in the data from the credit bureaus is becoming even more profound because of the director Pulte's initiatives to provide more innovation into the different credit bureaus. And I know that we here at Equifax are really focused on providing alternative data to the consumers. And I know our counterparts at Experian and TransUnion are doing the same. And I know you've had the opportunity to look at some of the alternative data, especially the data coming from Equifax around telco utility. And I just wanted to get your perspective on, how do you think that is impacting borrowers, especially as we're coming into these new proposed models?
Yeah, so right now, I think there's an opportunity, right? So we've been doing one thing the same way for, many decades. And if we have to start changing, I think it's a good time to also rethink what we're doing. And, there's so much more data now. The utility data is really a great example. And we have a lot of people who operate in a very different economy than they used to. So not everyone has the same job at the same firm for 20 or 30 years, earning a paycheck every other week. And so as we have people in a more variety of economic circumstances and we have more data, it would be useful to bring that in. But we don't think the solution is to take all of that data and then put it into one score.
Right.
So obviously that would be a useful thing to do, but that's not really going to be sufficient. So we would hope is that in addition to improved scores, with more data and better data, we also start to let the investors know and the credit decision makers know a little bit more about the underlying components of how that score was developed. And the utility data is like a great opportunity. Rental data is another one. There's many places where people who might have had trouble with some traditional credit might be doing really well on something like their utility bills or their rent, which may be a much better indication of how they'll do on a mortgage than how they did on either some medical bill or some small department store credit card where they had a dispute, right? So there's just a fuller picture that we can get of a borrower. The other thing that we've really learned over time is that like the credit score itself is only about whether or not someone becomes delinquent. Mm-hmm. It's not really about whether or not they can sustain their financial position over time. And we've actually found there's some people who have low credit scores because they miss payments from time to time because their income isn't steady or because they had an unexpected expense, who actually always become current again. Right, so that's still going to produce a low credit score, but they may still be a very viable borrower.
Right, and still have the ability to pay and
actually moving into home actually maybe make them more stable, right? So that we really need to start thinking of not just a single measure of credit risk, but think of a variety of measures and how they interact to describe that whole person, right? Not just their weight, not just their height, but their weight, their height, how fast they can run. Do they have experience throwing a javelin? Right, we can get a lot more information into this decision.
That's great. Well, do you have anything else that you would like our listeners to know about credit scoring? Anything else that you would like to leave them with as a parting note?
Yeah, I think as a parting note, I would just say, hey, this is an opportunity. It's a little scary. It's threatening. Some of our business models are being upset. Even on our side, we don't know exactly what models we're going to provide to our clients. People are starting to ask questions. But I think we should try and take this as a learning opportunity to create something better. Obviously, we've been doing something one way. It's fine, but it's certainly not the best. So let's try and improve what we're doing in the future.
Thank you so much for your insights. We really appreciate your perspectives on what's happening in the industry. For our listeners who would like to reach out to you, where can they find you?
They can find our website, ad-co.com, and there's contact us there. On the financial side, it's FICYCLE, FICYCLE.org, if they're interested in the financial education. Anyway, thank you so much for having me. It's always a pleasure to talk to you and work with Equifax.
Likewise, Andrew. You're always a great partner, and we really appreciate it.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.